What if your investment account could automatically sell your losers, lock in a tax deduction, and then immediately put that money back to work, all without you lifting a finger? Wealthsimple says that's exactly what their new direct indexing product does. But here in Canada, the math is more complicated than their marketing suggests. In this video, we're going deep on Wealthsimple Direct Indexing. We'll explain what it actually is, how it works, what it costs, and most importantly, whether the tax benefits that make this product so compelling in the United States actually translate to Canadian investors under CRA rules. By the end, you'll know exactly whether this is a product worth considering for your situation or whether you're better off staying with a simple low-cost ETF portfolio. Let's get into it. Let's start with the basics, because direct indexing sounds more complicated than it is. When you invest in an ETF like VFV, the Vanguard S&P 500 ETF, you're buying one single fund that holds 500 companies inside it. You own the fund, not the individual stocks. Direct indexing flips that model. Instead of buying the wrapper, you buy the underlying stocks directly. So rather than owning one unit of VFV, you'd own fractional shares of all 500 companies in the S&P 500, Apple, Microsoft, Amazon, and so on, held individually in your account. Why does that matter? Two reasons. First, customization. Because you own individual stocks, you can exclude specific companies, say, tobacco firms or oil producers, without blowing up your exposure to the entire index. Second, and this is the big one, tax loss harvesting. When one of those 500 stocks drops in value, the platform can automatically sell it, realize a capital loss, and use that loss to offset capital gains elsewhere in your portfolio. Then it immediately buys a similar, but not identical, stock to maintain your index exposure. The goal is to track the index while constantly generating tax deductions along the way. In the US, this has been a legitimate wealth management strategy for ultra-high net worth investors for decades. Companies like Parametric and Aprio were doing this for $1 million plus minimums. Wealthsimple is making a version of it accessible at $100,000. That's genuinely interesting. But the US tax system and the Canadian tax system are very different animals, and that matters enormously for how much value you actually get here. So what exactly is Wealthsimple offering? As of 2024, their direct indexing product is available to investors with a minimum of $100,000 in a non-registered account, and that non-registered part is critical. We'll come back to it. The product tracks the S&P 500, the S&P/TSX 60, or a combination, holding the individual constituent stocks rather than the ETFs. Now, let's talk fees, because this is where a lot of people stop reading the fine print. Wealthsimple charges 0.4% per year for their direct indexing product. Compare that to holding VFV yourself. That ETF has a management expense ratio of just 0.09%. Or XEQT, a one-ticket globally diversified ETF, at 0.2%. So you're paying roughly 0.2% to 0.3% more per year for direct indexing. On a $100,000 portfolio, that's a difference of $200 to $300 per year. On $500,000, it's $1,000 to $1,500 per year in extra fees. That's not a deal breaker. If the tax savings exceed the fee drag, you come out ahead. But it means the burden of proof is on the tax loss harvesting to actually deliver. And here's a number worth anchoring on. Research from Vanguard and others suggests that tax loss harvesting in the US can add roughly 0.5% to 1.5% in after-tax alpha per year, depending on market volatility and your tax rate. So in theory, the math can work. But that research is based on US capital gains tax rates and US tax law. Canada is a different story. Okay, this is the section that most Canadian finance coverage glosses over, and it's arguably the most important part of this whole conversation. Tax loss harvesting works differently in Canada, and in some ways, it's more restrictive. Here are the key CRA rules you need to know. First, capital losses in Canada can only offset capital gains. You cannot use a capital loss to reduce your employment income or business income. In the US, you can deduct up to $3,000 of net capital losses against ordinary income per year. In Canada, 0. If you don't have capital gains to offset, your losses carry forward indefinitely. Yes, but they don't help you right now. Second, the superficial loss rule. This is Canada's version of the US wash sale rule, and it's critical. If you sell a security at a loss and you, or an affiliated person, buys the same or identical security within 30 days before or after the sale, CRA denies the loss. The loss gets added to the adjusted cost base of the repurchased security instead. This means the tax loss harvesting algorithm has to buy a genuinely different but correlated stock. Sell Royal Bank of Canada at a loss, buy Toronto Dominion Bank instead, for example. That works. As long as TD and RBC don't move in perfect lockstep, you maintain similar exposure. But the substitution isn't perfect, and that tracking error has a cost. Third, and this is big, direct indexing only makes sense in a taxable, non-registered account. In your TFSA, there's no capital gains tax anyway, so tax loss harvesting has zero value. In your RRSP or FHSA, same thing, gains are sheltered. This means the entire value proposition of this product is locked to your non-registered account. And for many Canadians who are still maxing out their TFSA and RRSP contribution room, the non-registered account is either small or doesn't exist yet. So who is this actually for? Let's be specific. The investor who gets the most value from Wealthsimple Direct Indexing looks something like this. They're in a high marginal tax bracket. Think $150,000 plus in income, meaning their capital gains inclusion rate actually stings. They have a significant non-registered portfolio, at least $100,000, but ideally $250,000 or more, because the tax loss harvesting opportunities scale with portfolio size. They already have their TFSA and RRSP maxed out, and they're planning to hold this portfolio for the long term, not making frequent withdrawals that would disrupt the strategy. If that's you, direct indexing is at least worth a serious look. The combination of automated harvesting, index exposure, and customization options could genuinely add value over time. But here's who this is probably not for. If you're still building your TFSA and RRSP, max those first. The tax shelter you get from a TFSA is worth $0 in fees, and that's hard to beat. If you're in a lower tax bracket, capital gains tax isn't your biggest problem yet. If your non-registered account is under $100,000, you don't qualify anyway. And if you're a disciplined DIY investor comfortable holding XEQT or VQT, the 0.4% fee for something you could approximate yourself may not be worth it. There's also a simplicity argument. Holding 500 individual stocks creates a lot of taxable events, a complex ACB tracking situation, and a longer tax return. Wealthsimple handles this automatically, but if you ever want to transfer that account to another broker, you're looking at transferring hundreds of individual positions. That's not impossible, but it's friction. Here's the bottom line. Wealthsimple Direct Indexing is a genuinely interesting product, and for the right investor, it could deliver real after-tax value. But it is not a product for everyone, and the US-style marketing around tax loss harvesting needs to be filtered through the Canadian tax lens before you get too excited. The three things to remember. 1. The tax benefit only applies to non-registered accounts. Your TFSA and RRSP don't benefit at all. 2. CRA's superficial loss rule and the capital gains only offset rule limit how powerful the harvesting actually is compared to the US. 3. The 0.4% fee is real. The tax alpha needs to consistently exceed that fee drag, and in calm market years with few losses to harvest, it may not. If you're a high-income earner with a large non-registered account and your registered accounts are already maxed, this is worth exploring. For everyone else, keep it simple, keep costs low, and let compounding do the work.